So we'll move on and get started, and those joining will just be able to catch up because it will be recorded this and shared afterwards. And I'm just going to go on and sort of give you an overview today. So I want to obviously welcome you to the very first webinar we've done for 2022, and we hope you find the rest of this event enjoyable today. It's not the same as doing a face-to-face event, but hopefully sometime during this year we'll be back doing a face-to-face event again. But just for today, just a reminder, for your convenience, microphones and cameras for yourselves will be off so people can't see you and can't hear you. If you've got any questions that you'd like to ask as you go along, either send us in the chat button at the bottom or send me an email and we'll try to pick those up and ask them at the appropriate time. And if we don't get a chance during the webinar, we will answer them afterwards for you. And also thank you very much for all the people that have sent questions in beforehand of the meeting. I've made sure I've kept all the really hard ones for Shane. Timings for today, I'm going to spend about 10 minutes giving you a quick update what we've been doing at BerryNote recently and how that will benefit you. And then we're passing you over to Shane. We'll spend about 45 minutes explaining what's happening with the investment markets, especially interesting in the last few days, and what he thinks the plans are for the coming months. And then after the event, you will be able to get a copy of this video to watch at your leisure. But also we will ask you for some feedback on how you found the event. And we do find that really valuable and really useful, and it helps shape any future events we do for your benefit. So first of all, moving on to sort of financial planning education. Over the last few months behind the scenes, we've been working quite hard to produce some new information and resources that you could use for either for yourselves or for your family and friends. First one is we've wrote the foreword for a book called Enough. That's a very interesting book explaining about what people need to do with their financial planning to be able to know that they've got enough to be able to lead the lifestyle that they want to do. It very much sort of explains what we do with yourselves as our clients, so it'll be no surprise to you when you read the book, but I think you'll find it quite refreshing to read. It's available as a free PDF to download from our website. So if you go to our website and look at either the What We Do tab or Do I Have Enough tab, you'll be able to get a free download of that book, and feel free to share it with any family or friends that you want. They can go on themselves and register to receive it. We've also launched a very much slimmed down light version of the financial planning software that we use with yourselves called Truth About Money. And this allows you to be able to log on and put some basic details in, fairly generic, but it will give you a very rough idea of what your financial plan might look like. It's not as good and as in-depth as the one we use with you personally, but people starting off with their financial planning would find this really useful. Again, it's free. They can log on, register, all their data stays safe and secure. And then finally, we decided to be writing a guide each month on a different topic of financial planning, whether that's leaving money to your children, inheritances now or later, retirement planning, or our latest one that we've just done, which is what to do for the end of the tax year. These again are on our website under the guide section, free to download. We've got really good feedback from those people that have read them, that they say they're very easy to read but very informative, so they're not really long and boring. They're quite quick and to the point, and have been very helpful. So once a month we'll be putting a new guide on there, but please help yourself to look at those and share them with anybody that you want. And I just want to say thank you very much for clients that have made recommendations and referrals for us this year, because at BerryNote the way we grow is by referrals, when people are pleased by what we are doing. And hopefully these guides that you've got, the Truth About Money and the Enough book, is something that you can help encourage people to start looking at their own financial planning. And if they need somebody to help them, then just let us know. Moving on from there, I just wanted to give you a quick team update. Last month we introduced you to Lily, Holly and Leah, who did a little video cameo for you. They've all settled in really well and are now becoming really integral parts of the BerryNote team. You'll be seeing them more in the meetings that we have. They do a lot more of the preparation and sitting in meetings, and they're going through, a very sort of steep learning curve, but they're doing it with a great attitude, and it's been really helpful. Annie is also progressing really well on her apprenticeship programme and supporting Diane and Nina really well. But also on from there, I just want to say congratulations to Dan. Dan has now become a Berry and Oak financial planner. He's been doing quite a lot of work and assessments and sat in meetings with us for the next couple of years. And he's passed our sort of rigorous training programme, and he's now helping to look after a lot of clients as financial planner in his own right. So again, you'll be seeing more of Dan in the upcoming meetings. And then just a quick bit of news that, as you know, last year we took on 2 graduates. This year we're going to do another programme to bring in either a graduate or an apprentice to join us, and we'll be opening up our applications for that in February. And last year we got 41 applications, which was quite overwhelming, so interesting to see what we get this year. And then just a few more little Berry and Oak updates for you. We've just been awarded a Cyber Essentials certification, which is a government-backed initiative to make sure firms are taking their cybersecurity seriously. It's especially important for you, our clients, because it shows you that we're looking after your data and security at the topmost level that we can do. We've also been congratulated to be in the top 100 firms of the UK for financial planning, and that's for the 4th year running. So the team are really pleased with that. And we've also are a finalist in 3 different awards in the Yorkshire Financial Awards. And there's a glittering ceremony coming up on the 24th of February at the Armouries, where Sarah's in the final for Director of the Year, the team's in the final for Financial Advisor Team of the Year, and I've been put into the final as Independent Financial Advisor of the Year. So fingers crossed for us all how we will do on that night. And then moving on to one of the last bits I'd like to update you on. Thank you very much for all those that helped fill in our client survey that we did last summer. It was really interesting. We had some wonderful feedback, and it's given us some good ideas for some things we're going to do to bring in and enhance the service even further that we deliver for you. And you'll be seeing some of those in the coming months. But we put it together as just like a little animation that explains the results that we got in the survey. So it's going to take about 2 minutes. There is a bit of a sound on it, but it's more elevator music, so don't worry if you can't hear it too much. Hopefully you'll enjoy this show. So there you go. So hopefully you found that interesting, and thank you once again for giving me your feedback, and it's been very useful in helping us shape some of the things that we'll be bringing out in the next few months. But moving on from there, I'd like to introduce to Shane again. Shane, as you know, is the Chief Investment Officer for U Asset Management, who manage a number of the portfolios for our clients. And today, Shane's going to sort of share his thoughts on what's happening with markets at the moment, explain what's happened to the portfolios in recent times, and crystal ball time, what's happening next. So Shane,
thank you, Andrew. Thank you very much. Let's see if I can be as seamless as Andrew was with his computer skills. Afternoon, everyone. We've already had some questions emailed in, which is great. So we'll cover those off at the end. If you've got any other questions you ask that are prompted as we go through this presentation, please write them down in the chat box, or I think email Sarah. I think she's monitoring the inbox on this one. So welcome. This is my first client presentation of the year. I think aptly timed by Andrew and the team. We're going to cover off review of the macro environment, so what's happened over the last sort of 3 months, the short term, and then cover off how that has affected the portfolios as well. Then we look at the longer term, and this is the time of year where we update our stay invested slides. So those really important messages for making sure you are better investors in the long term, trying to avoid those traps, those behavioural traps that we all sort of succumb to at some point. Then, as Andrew said, dust down the crystal ball and give you an outlook of what's happening and what we think is going to happen over the next 1, 2, 3 or 4 years or longer. And then, all importantly, some space for some Q&A, some interaction. So it's really about sort of proof of the pandemic pudding. What has happened since the bottom of the pandemic? And here's the chart of 2 of our portfolios, portfolio 3 and portfolio 8 in the range of the active range that we run. And you can see here portfolio 5 from the trough, which was the 23rd of March to when was that? Friday, has returned 35.5%, which I think, considering everything was going on all the news stream at the in March 2020, is quite significant. If you take your risk profile up a little bit further to portfolio 8, more growthy, it's over 50% return. Now, that's all well and good. Has it beat other areas? So if you look at inflation and cash, you can see there. Inflation and cash over that same nearly 2-year period, so significant outperformance over that. If you take the average for portfolio 5, so that sits in the investment sector, 20 to 6% shares, so the average fund in that sector outperformed that, so that's really encouraging. And finally, for the portfolio 8, that's outperformed that average as well. In fact, our portfolio 5 just slightly underperforming the higher benchmark for the higher risk fund. So we're really pleased, and I hope you are as clients really pleased about the investment returns, which was obviously one of the 3 biggest risks for people already not in retirement yet, and in retirement was investment returns, and it is a key part of what Andrew and his team does in the financial planning. So how did we end 2021? What was the macro environment as we was running into the end of 2021? Well, everything was going swimmingly until sort of November hit, and then we had obviously the onset of the Omicron variant from South Africa. That sort of got volatility really worried around the marketplace, and not only that, it sort of really worried the central banks as well about what they were going to do. Up until then, it looked like COVID was very much under control, and the Delta variant that was found in July was getting under control with good vaccination programs and increased testing. So it was looking good, but Omicron came along, and that really muddied the waters. But it wasn't just Omicron that the central banks worried about as well. This image is supposed to be reflecting inflation, so people at the tills. Inflation continued to drag higher and pretty much dominated most of the off days we had in the market of 2021. So with supply chain shortages, lockdowns around the globe, shortages of, excuse me, lots of different components meant not only was the supply side constrained, but the demand side was increasing rapidly, purely on the side of central bank initiatives, people having additional savings. So demand was high and supply was constrained. That meant if you did your 101 in economics, prices will rise. Now, originally back in sort of February, March, the central banks led us to believe that this was going to be a transitory level of inflation, that it would dissipate extremely quickly. Now, we weren't in that camp. We felt this was going to be a little bit stickier, that it was definitely going to roll over into 2022. So we sort of invested accordingly. We invested in some value equities, which tend to do particularly well in a rising inflation environment, as well as some inflation-linked bonds, and they've proved to be really good beneficiaries of the portfolios. Ultimately, though, what we're looking for from our central banks, and this is the picture of the Monetary Policy Committee at the Bank of England, and the guy at the very front there is Andrew Bailey, the chairman of the Bank of England. We're looking for them to give us some not just rhetoric, but to actually walk the walk as well on how they're going to move from the emergency conditions that were put in place for COVID-19 nearly 2 years ago to something akin to more normal conditions. Now, even with the offset of Omicron, we did expect in November for the Bank of England to raise interest rates. They didn't. They stalled. They wanted a little bit more data, both on the Omicron variant, how prolific that was going to be and how deadly that was going to be, but also they wanted a few more data points on the furloughing program to see how successful that had been before they make any changes to interest rates. Now, luckily for us, December rolled round. All the data was pointing to Omicron being absolutely more communicable, but not as serious as previous variants. And we do hope that continues to be the case for COVID-19. I don't want to feel like I'm underplaying. COVID-19 has been incredibly serious, and I feel for anyone who's been affected directly or indirectly by this terrible disease. But it does look like the new variants are becoming less serious if you catch it. Hence why there hasn't been as many lockdowns as we saw for the Delta as we did for the Omicron. So a bit of confidence now that as we're in 2022, COVID becomes less of a problem. What does become the problem, though, is the policymakers moving from this accommodative, easy monetary policy where there's a lot of liquidity, interest rates are extremely low, there's quantitative easing to make sure the markets are working well, moving away from that and getting to something akin to more normal. Now, we saw the first move from the Bank of England eventually in their December meeting, where they did raise rates by 0.15% to hit where we are at a 0.25% now, with rhetoric that they're looking to potentially have more rate rises in 2022, but that'll be data dependent. Most significant player in the central bank world is the Federal Reserve. That's the US's central bank, and this is Jerome Powell. He's chair of the Federal Reserve. So not only was he navigating inflation and the new Omicron variant, he was also navigating his own tenure as well. So Jerome Powell tenure finishes in February, and in November time, we were hoping to see who Joe Biden would nominate as the next head. Now, normally, heads of the Federal Reserve do get 2 consecutive terms, and it was all likely that Jerome Powell would be given a second term. However, some internal politics sort of queried the patch there. Some of the members of the Federal Reserve, the voting members, were found to have not been as whiter than white as you'd expect, and did some trades during probably some of the most volatile periods in the market, but knowing what they were going to be doing to combat that. So trying to bend, not trying to bend, that could be perceived to have benefited from the information. Not that they did, they were pre-arranged rebalancing trades, yet they should have been more open and transparent about what was going on. So there was a lot of concern about who was going to head up the Federal Reserve. Was there going to be continuity? That created a lot more volatility in the markets. Inflation continued to rise, and we had the Omicron variant. There was a lot of volatility all throughout November. Federal Reserve in November did announce that they were going to cease their quantitative easing program, and that was going to finish in June. And this in December, They fully announced that, and it would finish in June, and it looked like there was going to be 3 interest rate rises in 2022, according to their dot plots, and I'll come on to that in a moment. So the biggest focus for us going into the end of 2021 and coming out into 2022 is going to be the central bankers and policymakers. And here you see the rates for the US and the different people in charge. You can see here Bernanke in green. He was in charge during the global financial crisis, brought rates down to the historic lows that they hadn't been for decades. Yellen in the lighter green had the job of raising those rates in 2015 and 16 to get them off the floor, and Powell was handed the baton to continue that rate rising process. Powell's had the unenviable task of lowering those once again to combat the COVID crisis, and now with the dotted line, that's the projection for him raising those rates again. Now, Jerome Powell does have a bit of history of putting a narrative that's probably too aggressive in place. Now, if you were invested in 2018, you would have benefited from an exceptionally good 2016 and 2017 after rates had finally got off zero and we were in a rate rising environment. Investments did particularly well. Now, what happened in 2018 was Jerome Powell came out in September and said he felt rates were nowhere near where they should be. This triggered a downturn in markets in the final quarter of 2018 because typically recessions have been caused. I think it's 29 out of the last 40 recessions since 1960 have been caused, 1930, sorry, have bbeen caused by central bankers raising rates too high too quickly. So there was that concern that he was overheating the economy. He back traded back in Christmas Eve in 2018, and the market rose, and subsequently we had a very positive 2019. So he's got a very difficult needle to thread this time around. The market will be very careful and very skeptical of his words, and it's the actions that need to be key. So this is the plan for the Federal Reserve. This is what we call the dot plots, and each member of the Federal Reserve estimates where they think interest rates will be at the end of that year. And you can see here in 2021 that no one expected a rate rise in 2021, but the key one here is what is the median expectation for next year, and it's estimating a rate, 3 rate rises in 2021. So we entered 2022 with a backdrop of a potential interest rate rise environment, and how is the market going to handle that? Now, we'll look at what our view is of that, but just remember that those figures I showed you at the beginning of 55% and 35% were including the first 3 weeks of 2021 as well, which has been volatile, but we'll come on to that on the outlook side. But how has this affected the portfolios for the last quarter and throughout 2021? Here's our active range of portfolios over the quarter and over the last 6 months. You see the range here, extremely positive. And these are benchmarks underneath here. We had an extremely good 2020 and extremely good 2019, another positive year for 2021, albeit, oh, this is our enhanced passive, sorry, we'll go into 1 year there, albeit slightly behind benchmarks this year as well, but we're happy with that because that means our long-term returns are steady. We're more diversified than the marketplace at the moment, and that's been borne out so far in 2022. So very pleased with the returns over the last quarter and the 6 months. It's the same with our enhanced passive range as well. As you know, we have our active models and our enhanced passive models. It's down to Andrew and the team to decide which one is most suitable for you. Most importantly, how's it been over the longer term? So this is the 1 year. This is our active range, and you can see here solid performance over 1 year, adding to positive returns in 20 and 19. So 3-year return track record, exceptionally good. Seen as here. You can see here the drop we suffered for COVID, and you can see how quickly those returns recovered there. So think about that when we go through the staying invested slides later on. And that's against the benchmarks, as you can see, all above. And 5 years. This is the drop down I was referring to earlier with Jerome Powell in Q4, but recovered again quickly. And it's just a stark reminder that, you know, investment journeys aren't a smooth line. Even the low risk portfolios aren't always going to be immune to everything, but the longer you stay invested, the better your returns. And it's my job as well to help you be armed and knowledge of expectations, so you can not over react when markets are more volatile than maybe expected. And it's a very similar picture for enhanced passive as well. All of these data points are available. If you wish us to do data points over different points, please let us know. We can cut and splice them exactly as you want. We find it's good to do them in whole years as well, so it's, you know, has nothing to hide. Very similar pattern for 3 years to active, and the same for 5 years as well. Active slightly outperforming passive over this current 5-year period. So really pleased with investment returns, especially as it's one of the sort of key worries if you're not retired, and if you are retired, on the investment returns. And it's the key part of that will be Andrew and the team at Berry & Oak sort of deciding what your level of risk tolerance will be. That's the key. Our job then is to make sure that whatever product we are running adheres to those risk tolerances. So if you are a 5 out of 10, you are receiving the right appropriate risk for a 5 out of 10. It doesn't creep up to a 7 and you get some nasty surprises. Conversely, it doesn't creep down to a 3 and you're not getting the returns you should be getting. So that is our job. One of the jobs as well is to make sure that clients are well informed. And this is a series of slides we've put together called Stay Invested. I'm just getting the entire pack complied by our compliance team, and I'll pass that to Andrew, and if he feels it's suitable, he can use it in some of his meetings. Now, what we looked at last year was, as 2020 was an exceptionally volatile year with COVID, how did the individual quarters fit within 2020? And it was really no surprise that the first quarter, so January, February, March last year, was, out of the 65 quarters that we've been running at that time, the worst, or in the case of Portfolio 3, the second worst quarter we'd ever had. It was that an extreme environment, and that includes the global financial crisis we had in 2007. Interestingly, though, the following quarter, once the market had decided that enough stimulus was in place to combat whatever COVID was going to throw at the world global economy, the next quarter, Q2, which was April, May, and June, was one of the best quarters we'd had. If it wasn't the best, it was in the top 2 or 3. So fantastic. Q3 was a solid quarter, but Q4, again, one of the best quarters we'd had. So overall, it was a very good year, and a good year. Just showed you the importance of not having a knee-jerk reaction to the environment we found ourselves in 2020. This is the environment we had 69 quarters, so an extra 4 quarters experience. You know, we're running the portfolios over 17 years. How did they fit in? A similar-ish picture to 2020, where it started quite volatile, particularly for the lower risk portfolios, as the markets were looking at, or when will the liquidity be reduced, and inflation was starting to creep up. High inflation isn't particularly good for certain fixed income assets. Q2, good solid quarter, and Q3 and Q4, you know, they're the sort of bread and butter quarters on there. And if you look at Portfolio 5 as a whole, you can see here the spread of the 69 quarters. So this one here at the far end, that was Q1 2020, the worst one we'd ever had here. And here at the front here, that was Q2 2020. And what we like here, this is the sort of the asymmetry we want to see. And that is, in general, we have a lot more upside returns than we do downside returns. And it's roughly about 74% on the upside and 26% on the downside. So if you take it as a year, you know, in history shows us we like to take 3 steps forward, 1 step back, and we can continue doing that process. That means you're going to have some really good long-term returns, and those worries about investment returns might drop out of your top 3, and we hope they do. Now, we've got this data for all of the active portfolios, so irrespective of what portfolio you might be in, let us know, and I'll make sure I make that available to Andrew so you can exactly see where your portfolio sits and what the shape of returns are. We often get asked as well, does time matter? Yes, time does matter. It's about the length of time you spend in the markets. So the longer you're invested, the higher the probability is that you're going to get a better return. But also say, well, when I invest, does that matter? Yes and no, but it purely matters on how long you're purely invested for. Now, this is Portfolio 5 again. We take this as a standard model. We've done this data for all of the portfolios. There's some 16,840 rolling time periods that we've calculated here to give you this data. And what we found, if you're investing for 1 year, your dispersion of returns are huge. So this is actual data from Portfolio 5. If you were unlucky, your worst outcome for 1 year invested would have been minus 25%. And that was from April 2007 to April 2008. So that was at the nadir of the financial crisis, the worst point of the financial crisis. Now, do bear in mind, that was considerably less than the market was dropping. The market dropped over 50%. I'm not saying that's a good thing, but we did soften the blow for many investors. Now, the best 1 year return here was 39%. And ironically, that was exactly the following 12 months from this 25% drop. That was April 2008 to April 2009. So huge dispersion if you're only investing for 1 year. If you're investing for 2 years, the annualized returns drop dramatically. And you can see here, it suddenly matters a little bit less when you started to invest because that dispersion has dropped down. Now, if we roll that forward to 5 years, it doesn't matter when you invested over those rolling 5-year periods, there were no negative returns. So you would have made money. And what we're trying to point out here, when we roll through it all the way through to 17, what matters most is the length of time you're invested rather than when you invested. And now we've done 17 years here. You can see here that, you know, the dispersion is tiny because we've only got about 4 rolling 17-year periods on a month-by-month basis. But if you look here at 10 years, dispersion is tiny. And on average, for Portfolio 5, it's working out at roughly 7 to 8% per annum. Now, compound that and you're making an exceptionally good return. So, yes, that first year investment, yes, that can look extremely scary. However, the longer you invest for, even if you invested down here, if you invested for 12 years, you might be in this bottom one here, but look, you're coming back up to the average. The longer you invest for, the better it is. Now we're going to look at calendar years because they can tend to be a sticky point as well. You know, people looking at pure calendar year returns. This is the FTSE All Share, so the top 350 companies in the UK. And you can see here the blue bars, that's the total return you would have got in that 1 calendar year. And you can see here, probability-wise, you're better off investing for the long term because you've got more chance of getting a positive return than negative return. Interestingly as well, though, after a big negatives, there tends to be really good rallies as well. And it takes the adage of, if you miss the best 10 days of the market, that's what really hurts you. But to capture those best 10 days, you invariably have to suffer the worst 10 days as well. So have some robustness about your investment plan. Link with some really great people, such as the people at Berry and Oak, to help you through the tough times. Now that looks pretty straightforward. You go, that's fine, that's fine. I would have definitely stayed invested in 87 and 88 because look, all positive returns. However, these dots represent the lowest point in that calendar year of the market. Now, my daughter calls these the measles points, and it's like the way the market wants you to catch a cold. And you can see here, let's take 1987 as an example. The lowest point in 1987 was about minus 36%. And that was Black Monday, the crash in October 1987. And you can see there at that point, minus 36%. There was panic. However, if you'd stayed invested, the year turned positive. And what this chart is showing you is at every point where there is a low point, if you stay invested, you end up getting better. Not necessarily always positive. So if you look at 2008 here, the global financial crisis, down for the FTSE All Share, down nearly 44%, but recovered to only minus 35. So what we're saying here, stay invested, don't panic. And we have the same data for our portfolio. We've used portfolio 10 as an example, as the same example as the same sort of risk profile as the FTSE All Share. And you can see here for the 17 years, 16 calendar years, how we have performed, and we are very pleased with that return as well. Only 3 negative years, 14 positive years, and some of the low points are 0. So 2013, 2012, 2017, 2019, there was no negative low point in that year. So what we're just trying to, and I hope it doesn't come across as banging the drum too much, the best investment advice we could ever give you is to stay invested for longer and make sure in the appropriate timescale. So that's the stay invested deck. Now we're going to look at the outlook. We still need to take into account COVID cases. This shows you the number of confirmed cases, rolling confirmed cases over a rolling week for both the US and the UK. You can see here there was that spike upwards for Delta and a slight spike upwards for Omicron, but nothing hugely serious. But even though the number of cases were rivaling the wave we had towards the end of 2020, the number of deaths were massively lower, massively lower. Grey bar here being the UK, much lower deaths than we had the spike back in the winter of 2020. And that's given policymakers more confidence in not having to impose more penal lockdowns. And we've seen now that actually isolation periods are coming down. I would imagine at some point, a lot of the restrictions will disappear altogether. Slight drop down from the Delta variant for the US, another kick up when Omicron hit, purely down to 2 things. It's communicability, so a lot more communicable, and there's a huge amount of unvaccinated areas in the US that the struggle they have with is it's not a case of, I think they're up to about 74% vaccination rate, but that's not evenly spread across the US. There's huge pockets where vaccination rates are in single digits. So that's a bit of concern they have, whereas in the UK, I think it's more evenly spread geographically for us. So for us, we hope, and we were hoping this time last year, that COVID would be solved. We were hoping with renewed vaccinations, with boosters. I think Pfizer now have got the pill you can take, so it doesn't even have to be an injection. So the easier the method of delivery for the vaccine, the more successful it will be. So fingers crossed, crossing my toes, touching wood. Hopefully COVID won't be the main issue we have in 2022. Now, I think last time we showed you on these presentations, we were hitting a summer lull, and we were pointing out that this is the expectation you'd have as the market's moving from early cycle to mid-cycle. A mid-cycle will contain that change in interest rates, change in monetary policy, and you can see here it's continuing that pattern onwards. So it's keeping to the map that we fully expect. But what are we worried about as we hit into 2022? Well, we're hitting into an environment of rising interest rates. That's something to be really cognizant of. Politics in the US and politics in Europe. Now, that was, when I first wrote these slides, politics in France. And then we had Partygate, and then we've had Russia as well. So it's definitely politics in Europe on this one. Let's take rising interest rates first. What we expect, and we've had sort of track record on this, is before the hikes, and we saw that in December, that markets react favorably. They're like, yep, this is a great idea, and we fully understand why you're doing it. However, a bit like when I have to take my kids to the dentist, they fully understand why I'm taking to the dentist, but at the point of going to the dentist, all hell breaks loose. So you expect a bit of volatility around the time of the interest rate rises, which we're getting now. Now, arguably, it's probably overdone than we expected. The rotation has been fairly dramatic. So what's happening is the market saying all those stocks that did particularly well, all the stay-at-home stocks, all the stocks are in a huge growth environment that you're paying over the odds for that reliability of growth. They are now overvalued, and people are selling those, and they're buying the sort of stocks that will do well in a interest raising environment. Things like value equities, such as financials, such as some commodities, utilities, and areas like that. So we were already diversified into value stocks last year, which probably was a little bit of a drag on our performance, but we still did fantastic returns. Coming to the first 3 weeks of January, we are down, but probably half as much as the indices and our peer group on that. So diversified portfolios really help. And these are sort of the sectors that were largely ignored. So these are the sectors that should do well and correlated well in an interest rate rising environment: banks, financial services, value equities, energy. And this is where sort of Putin comes in with Russia as well. What doesn't do particularly well have been some of the high growth stocks that have done particularly well over 2020 and 2021. So it's not about rotating completely out of there. If you had an appropriately diversified portfolio all the way through, you will receive good, robust returns. The next thing we're probably going to hear about, so we've got the Federal Reserve speaking tonight, which is really important. So at 7 p.m, bear with me because I will be glued to the Blueburn screen to see what the Federal Reserve have got to announce. We expect them to confirm that they're going to increase the reduction of their quantitative easing program. So rather than finishing in June, we expect it to finish in March, maybe February, which then opens the door for more than 3 interest rate rises this year. So we maybe expect a rate rise as early as March, if not February, June, September, and possibly October as well. So the market's now factoring 4 interest rate rises. Some market participants are asking for more, but this is going to be the concern here. This is the stat I was talking about previously, the number of recessions caused. The main cause of that is monetary policy tightening, which is interest rate rises in the main economies. So we're going to move from a position where everyone understands why we're raising interest rates is primarily to get away from this emergency conditions, which aren't needed any longer, because the longer we stay in this, the more unintended consequences we're going to have, such as higher inflation, and to combat inflation as well. Now, coming back to inflation, we feel that at some point we'll probably hit the peak, maybe April, May, and then we think it will start rolling over year on year as supply chains start to reopen. As interest rate rises, it becomes a dampening effect. Traditionally, higher interest rates causes more people to save, reduces demand, demand reduces, and if supply is increasing, it's the opposite combination we had last time. That's going to be a price depressant, and we should see prices come down. That is the theory on that one. So we're in an interest raising year. Don't forget, when you look back at those years I pointed out, sort of 2016, 2017, 2 positive years that didn't have any negative points in from our portfolios. They were years where interest rate rises were going quickly. So it doesn't mean interest rate rises is bad for markets and your returns. What it does mean is it can be volatile when we start. Once we're going, the market quite like that because it can see it's got sort of a clear road ahead. It knows what central bankers are going to be doing. Conversely, as we get to the end of that journey, that can be the volatile period as well, as we saw in Q4 2018. But we also have US politics to worry about as well. Now, this year is the midterm elections for the US. This is where they elect a lot of the houses in seats in the House of Representatives, seats in the Senate, and typically it can be a negative year for markets. So not only do we have the interest rates and challenging us, we have a negative year for politics as well. This might be a different year because we've got different environments to be combating here. We don't think this year will be a negative year, so it'll sort of buck the trend from previous ones. What we do expect is a really close election between the Democrats and Republicans. It might end up with a sort of split Congress where not much gets done, which in an environment of rising interest rates will be really good news for corporates because they know new taxes are going to come through, and it'll be a nice environment for investing. Then we have Europe. Now, originally, this was the chart for the French elections, which start in April. Now, it's going to be a really interesting one from our point of view, is because we believe Macron, and he's already started it with the fishes and the seas fishing rights, that he's going to use the UK pretty much as a punching bag and Brexit as a punching bag for that. So expect some quite volatile language coming out of France. It'll be interesting to see who's going to be the main challenger to Macron. Le Pen runs effectively the what used to be the National Front in France. It got renamed. Pécresse She's independent. She sort of labelled herself as a cross between Angela Merkel and Margaret Thatcher. So we'll see how well she does. So keep a close eye on France on that one. But also in Europe as well, we have Russia beating the drum as well. Now, this is something I did a video blog on a couple of weeks ago when it wasn't being talked about. For us, this is an opportune time for Putin. Energy prices are soaring. Russia's looking fairly in rude health for that, which means he gets more support and backing from Moscow on this. Not that he needs much, to be honest. And this is about making sure NATO doesn't roll out any more memberships, because Ukraine isn't part of NATO yet. And this is why they're amassing people along the border. It's going to be interesting 3 or 4 weeks, purely because if Putin is going to do something, it has to be soon. Because once we get the thaw in Ukraine, there's no way he can roll his tanks out across the mud. So while it's still snowy and frozen, this is the danger. And if we roll back 8 years to when Crimea was annexed, it was this time of year that it happened. So they're very adept at winter conditions before the thaw comes in. So just keep a close eye on that. Will it affect markets? One of the questions was, is there any way we can invest against this? If you look back in 2014, when Crimea was annexed, there was a lot more going on. Markets weren't overly concerned about the incursions that were being effective there. There's not really any way you can invest to take into account military actions. It's one of those environments where you just have to sort of make sure you're invested for the long term, appropriately diversified. It's sort of a little bit like the threat we had in 2016 with Donald Trump coming to power and all the talks and skirmishes and threats we had with North Korea. Now, that was one of our sort of high impact but low probability environments, but it's still something you have to take account of. So just some key takeaways. Just like to reassure you that performance has been strong throughout the pandemic, and hopefully you've seen that as well. But we do focus on our long-term returns. We are willing to look different to the market over the short term in order to make sure long-term returns are key, and that's hopefully going to solve those worries of people in retirement and before retirement on that. We do expect conditions of central banks to climb back to level of normality during this period. It will be a bit volatile, but for clients, it's about staying invested. You know, over time, long-term returns are your key. If there are any concerns in the marketplace, I know Andrew will call me. We'll discuss them. We could do a short video. We could do a short article to reassure clients as well. Now, COVID is starting to sort of take less of the limelight. Politics is certainly coming back in play, but for us, the biggest risk at this moment in time is definitely going to be policy error. And can the central banks maneuver us into a situation for, there you go, stop share, for getting us back to sort of some level of normality?
Well, brilliant, Shane. Thank you very much for that presentation.
No, pleasure.
That was very, very interesting. I think hopefully that's answered a lot of our clients' questions about what's going on at the moment. And I think the biggest thing that I should probably thank you for on behalf of our clients is when you're sat down tonight watching the Fed on TV, as fair to say, hopefully most of the clients won't be, and I know I certainly won't be. So thank you for taking one for the team to watch that. I'm sure it'll be very interesting. But no, really, really good. We did have a few questions before, and I know you covered one or two when you went through. One that came up seems so long ago now, only last week. When I did a review with somebody, the portfolio was down about 1.5% for the year, and they felt quite surprised because they'd not really heard anything about it. And the main reason was, when we looked at it, is the overseas weighting had been what had fallen down. The UK was still doing pretty well. And my view is the reason we didn't hear about it because it wasn't the UK market, so therefore the UK papers and media wasn't shouting about what was going around in the rest of the world. A week later, we all know about it now. So what's gone on really the last few days, and what's caused this? Do you really think, and do we need to be sort of more worried about it, or has it just been that initial flow of going into this high inflation interest rate world that's suddenly a bit of a shock?
No, it is a really good question and probably surmises what's gone in 2022 so far. I think one of the reasons it probably didn't hit the headlines as much is because the media were falling over themselves on Partygate with with Boris. So there was a lot of other news, easy news to get really get your teeth into. I think beyond that, if you looked at something other than sort of the BBC News, ITV News, or Sky, then you could see what was happening in the markets. And why, Andrew, you've hit the nail on the head. We're in an environment now where 2022 is going to look very different to 2020 and 2021. So 2020 and 2021 was all about making life easy, having lots of stimulus in place, and that was really good for growth stocks because investors weren't sure of which companies were going to survive. So you paid high price for companies that had strong balance sheets, for companies that had moats. Now, what do I mean by moats? I mean high barriers to entry, hard to replicate business models. So if you think of something like Amazon, you and I could have a really good idea, but we're not going to be able to replicate Amazon in our sort of garage over the next 6 months. It's hard to replicate Amazon instantly. So people would pay through the nose for that certainty of growth. What you've got now is an environment where, with raising interest rates, with liquidity being withdrawn, with a more certainty about growth in the marketplace, the outlook is, well, growth isn't going to be as scarce as I thought it was going to be in 2021 and 2020. So if growth is more available, I don't have to pay through the nose for those companies that I have super strong balance sheets, etc. I can buy some of the companies that have been overlooked over the last couple of years, and they will grow in this environment. Banks, financial services, some of the utilities. So you've had this complete switch around from what was on someone's shopping list in 2021 to being dropped off for something different in 2022. Did that make sense?
Yeah, no, really good answer. And probably none for that. There's been a lot of talk about inflation, and it started rearing its head a bit middle of last year in conversations, and I think became much higher than people were expecting. And there was a big word about it was transitory, otherwise known as temporary. Do you think it is really still temporary? Do you think it'll quickly wash itself out and not become as much of a concern?
It's interesting. So in 2021, we first started seeing the signs, and this was early January. You could see sort of inflation creeping up, and the central banks all said it's going to be temporary. This is a 1 quarter phenomenon. Nothing to worry about. We're happy if it reaches 3-4%. That's not a problem. But it persisted, and a lot of people's behavior persisted as well, because what made it worse was the supply shortages. So one of the biggest components of inflation for both, in the US and the UK has been used cars. So people couldn't buy the brand new car that they might wanted to buy because of their increase in savings. They might say, let's buy the new car. We've done everything else, but the car manufacturers couldn't get the components to build the new cars. So there was a dearth of cars available. So people turned to the used car market. And the used car market is a finite supply as well. And if you've got suddenly 5 people demanding the same car, whereas previously you had 1, prices are going to go up. So you had this sort of knock-on effect where used car prices went up because of the supply shortages, and inflation just kept feeding in on itself. Now, at some point, that will turn over, because no one's going to be buying used cars again this year if they bought them last year, arguably. So there will be a mathematical area where inflation does roll over. Now, we think it will peak sort of April, May, and then just start to roll over. The concern we have, though, with that, Andrew, is will the central bankers be taking that into account, or will they overreact to the high numbers we're seeing now? Now, we bought some relatively cheap inflation-linked bonds within the portfolios back in March, and they've done exceptionally well for us. Whereas, previously people weren't buying those because it was going to be temporary inflation. But we're not in the camp where we see sustained hyperinflation.
Okay, that's good to hear. And maybe on the similar bit about the inflation, etc. Given the apparent perpetual political and COVID uncertainty around the world, is there an investment that can be considered boringly safe for above inflation growth over the next 5 to 10 years? What a question.
What a question. I'd say active portfolio 5. No, it's a difficult one. I think it sort of marries in with some of the sort of points I was trying to make with the length you stay invest. The best thing about that question is someone asking for an investment term of 5 to 10 years. Brilliant. That is already halfway there to being a successful investment. I'd say what you need over that 5 to 10 years, it's going to be a different environment in the first 5 years and arguably the second 5 years. You know, you could go back over the last 20 years and split it into 5-year chunks. You'd need a different strategy for every part of that period. So diversification will be key. I don't think there's any single one-stop shop investment that you could lock up for 5 or 10 years, go back and go, okay, that did well. Inflation-linked bonds will do well in an interest rate environment that is, an inflation environment that's going up. But interest rate index-linked bonds do well when inflation's going up. But when inflation is coming down, they could be really damaging, really damaging. They're on a scale of, you know, what's the safest and the most risky parts of fixed income. Inflation-linked bonds in certain environments can be risky.
Right.
So whereas we held them in rising inflation, you know, we pat ourselves on the back, that's fantastic. We will be looking to offload those as and when we see inflation rolling over. Because as inflation goes down, the value of those bonds suddenly drops dramatically. So for that investor, I'd say there's not a sort of a dodge the question, a diversified portfolio that's appropriate to his risk, but investing 5 to 10 years is the absolute key.
Super. Well, I'd just like to say again on behalf of our clients, thank you very much for your stewardship on the investments that you've done, Shane. I know you've been looking after our clients' money for sort of 10 years plus.
It's been a pleasure.
We'll look back on that track record. You know, it has delivered really, really well. So thank you very much. Thank you for your time today. Hopefully when we do the next one of these, spring, summertime, it may well be face to face, and we'll welcome you back up to Yorkshire.
I cannot wait. I cannot wait.
Take care.
Thanks a lot. Everybody. Bye, everyone.